again. So I want to kind of pick up where we've left off here. Okay. We talked in the last lecture about the check the box rules, which are honestly so very, very, very important. And you will see the check the box rules on your exam, I can promise you. Probably more in the form of multiple choice, but we will ask questions very similar to this. We have this entity and it's created and it has how many owners? What are its options for federal income tax purposes? So absolutely, you will see the check the box rules again. And one thing I did forget to note here. This is on page 8. These are some of the procedural rules. If you elect to change your default classification, you can make it at any time, and it's effective 75 days prior to its filing or 12 months after its filing. It has to be signed by all the owners, and if you make an election, you basically can't make another election for 60 months, okay? So you have to stay with that for 5 years, and then if you want to change later, you can. So let's go back, and I want to talk about some of the different things that you see, okay, with that you'll see in corporate tax. And honestly, you see these not just in corporate tax, but these are some of the common law concepts. They're on page 2 of the lecture material, and they are in the book in a good bit more detail if you want to take a look at them in the book. But these are some of the common law. When we say common law, we mean things that were created via the courts. Now some of them are statutory, but at least they originated in the courts. And some of them are still only through case law that you can find information about it. And these are very squishy, very subjective. I know you accountants don't like that kind of stuff. But these are some overarching common law concepts that you very often see in corporate tax. And it's good to discuss them at the beginning because we will see them time and time again throughout the semester. And if you continue to practice tax, you will see them in all different areas of tax. The first one that's discussed in the book is the assignment of income doctrine. So this originated from a case, but it is now, in the tax code. And if I say the code in this class, that means the Internal Revenue Code, okay? What this means is if you earn income and it is yours, let's say I get paid $60,000, I can't basically assign that income away to somebody else and it be their income instead of mine. If I'm the one who's generating the income, I can't assign that to somebody else. Well, I can assign the income, but I can't assign the tax responsibility that goes with it. If it's my income, I have to pay the taxes on it. One concept I've talked about that's similar is the fruit stays with the tree. So, for example, if I own a rental property and I decide that I am going to give my son the rental income from that property, I can do that. I can gift him the money if I like, but I cannot give him the tax responsibility. I still have to pay taxes on that rental income because I own the tree. The tree is still mine, and I am just giving him the fruit. Whoever holds the tree or the underlying asset is going to hold the tax responsibility. I can't assign the fruit away, okay? Same concept. If I earn income from my job, I can't assign that income to somebody else. It is mine. I have to pay the tax responsibility. The tax burden is going to stay with me. Another concept that is discussed in the book, it's called the sham doctrine. So this is when the IRS goes in and says, you know what, with this sham, this transaction that you're creating, it's really just a sham. You're only doing this to avoid paying taxes. And there's no real business motivation. Your motivation is solely to avoid paying taxes. Now, you do not have an obligation to pay more taxes than you owe. Please understand that. That's why companies pay millions of dollars to sophisticated tax advisors to do things as tax efficiently as possible. Why pay more money in taxes than you have to, right? But you have to be very careful. You have to make sure you are not creating transactions solely for the tax benefit. Honestly, it's not usually that difficult to also find a business motivation behind it. But this is really why there's so many issues with tax shelters. Because often tax shelters are only done to create tax benefits, which is a problem under this sham doctrine. Anytime you're doing something just to save on taxes, then really you're not really doing anything. And it says here in the lecture material, the court must find that the taxpayer was motivated by no business purpose other than obtaining tax benefits, and that the tried transaction has no economic substance because no reasonable possibility of profit exists. So no reasonable possibility of profit. The next common law doctrine to consider is the economic substance doctrine. Ooh, this is a big one. We hear this one a lot. Okay, so with economic substance, it used to only be something you would find in the courts, but a few years back, maybe 5 years ago, they actually codified it. So that means they put it into the tax code. So now we have a code section, 77010, that says, all right, if you don't have any sort of economic substance, then it is basically not a valid transaction. I don't think 77010 is actually in. That's the annoying thing about using abridged codes. You're like at their mercy for what they think is important. Actually, it is in here. 7701 is in my book is on page 221. 7701 clarification of economic substance doctrine. Okay. In the case of any transaction to which the economic substance doctrine is relevant, such transaction shall be treated as having economic substance only if the transaction changes in a meaningful way, apart from the federal income tax effects, the taxpayer's economic position, and the taxpayer has substantial purpose for entering into such transaction. Honestly, close brother to the sham transaction doctrine. The difference with economic substance is now we have an actual code section to enforce against it. So what we're saying in economic substance is really you only have tax benefits. There's no real economic substance apart from that. Okay? The next one that we see also a lot is substance over form. So this means you on paper created one transaction, but in reality, your intent was to do something else. We usually see substance over form. The taxpayer is arguing form. And the IRS wants to trump that, so they come in and argue substance. They'll say, this may have been your form to create a 351 transaction, but the substance of it is something else. So this is when they will look past what you have made on paper to say it is something else. For example, if you have a 99-year lease with an option to purchase at the end for $1, is that a sale or a lease? On paper, it's a lease for 99 years, and then a sale for $1 the last year. Well, what about in substance? Is anybody really going to sign a 99-year lease and then buy it at the end for $1? That's not realistic. The IRS would come in and say, no, on paper you created a lease or in form, but in substance, this is a sale. Why would you do this? Because lease payments are fully tax deductible, whereas when you purchase land, or particularly if you purchase a building, depreciation has to be taken over time. So there may be motivation to treat a sale as a lease. Another way that you see substance over form is compensation or a dividend. And we'll see this in an example here in a little bit. So let's say we have a shareholder and they are receiving compensation from the company for their services as being a shareholder instead of receiving a dividend. It may be perfectly legitimate, but if all the other shareholders are receiving a dividend and they're not, or if they're receiving a rather large compensation in comparison to other shareholders, it may look a little funky, and they might say, what the company's really trying to do is pay them compensation and take a deduction for it because they're paying a salary. Whereas if the company was paying a dividend, they would not get a deduction. So that may be another time where we look past the form and say this is really what the substance of the transaction is. And honestly, this substance over form comes up all the time. Another one which is closely related to sham transaction and economic substance is business purpose. There must be some sort of business purpose out there other than tax motivation. Depending upon what code section you're looking at, the requirement for a valid business purpose may be a lot stronger. Some code sections, the business purpose requirement is very weak. You only need a very little bit. Other code sections, you need a lot. So it depends upon what you're looking at. The last one I want to discuss, which is also a biggie, is step transaction. Okay? So this is when you have multiple transactions, okay? And you are trying to treat them, each transaction separately. But the IRS comes in and says, no, what you're really trying to accomplish is one end goal with these 3 or 4 different transactions. So we are going to treat this as one large transaction and look at the consequences before the very first transaction and after the very last transaction instead of evaluating 4 different transactions individually for their tax purposes. And we will see an example of this in chapter 2. Honestly, you will see many examples of step transaction where we say, okay, well, what about if you have a shareholder who contributes property to a corporation and receives shares, but then 3 days later sells them to someone else pursuant to a prearranged agreement? Is that person really a shareholder? Should they really get 351 tax-free treatment? Because they're only a shareholder for 3 days, and they had an agreement to sell them immediately after. So that's kind of what step transaction is, where we look at multiple transactions and we step it together to create one big transaction. Step transaction can be argued by either the taxpayer or the IRS. Usually you see the IRS arguing this, but not always. In rare circumstances, you'll see the taxpayer arguing substance and the IRS arguing form. I have seen it. It's not impossible, but not common. Okay, so those are the common law doctrines that we'll see again and again, not just in this class, but I guess this is the only advanced tax class we offer, so probably won't see it again in school, but you'll see it again in practice if you're doing tax. Okay, so I want to take a look at the rates for corporate tax. Here we go. I found it. Section 11. Section 11, which is on page 7 in my code book. Again, it might be a little different in yours. Section 11 is the tax rate schedule for corporations. Okay? So if we look at this, and you need to make sure you know how to do this, the amount of tax imposed by subsection A shall be the sum of 15% of so much of the taxable income as does exceed $50,000. This is also on page 3 of your lecture material. 25% of so much as exceeds 50 but does not exceed 75. 34% of the tax that exceeds 75 but does not exceed 10 million. And 35% that exceeds $10 million. And then if you look down under section D at the flush language, the flush language means it's not actually part of a subsection, but it's still just as much law. In the case of a corporation which has taxable income in excess of $100,000, the amount of tax under the preceding sentence for such taxable year shall be increased by the lesser of 5% of such excess, or $11,750,000. If you look down in B2, if you are a personal service corporation, they do not get the benefit of graduated rates, and they are always taxed at 35%. So a qualified personal service corporation is a corporation engaged in the field of health, law, engineering, architecture, accounting, actuarial science, performing arts, or consulting, if the stock is held by employees performing such services. So, which would be really stupid. Why would you, create that kind of an entity? But anyway. All right. If you have a personal service corporation, there's a box at the top of an 1120 that you have to check. So if you notice in the flush language, we have this bubble, this catch-up language, this extra amount that we have to add to the pot to calculate taxable income. So the reason why we have this catch-up amount is basically just to make sure that if you have income over basically at that 34% range, then you are really getting taxed at a flat 34%. So that's why we have that catch-up language, and I'll show you what I mean. So, and we're going to do an example of this here in just a minute. So, hold on to that. Okay. Some differences between corporations and individuals. So I said we talk about that. Let's talk about it. So the first big way, corporations do not have personal exemptions. No such thing. No such thing as an above the line or below the line deduction. It's all above the line. They don't have standard deductions. itemized deductions. None of that for corporations. Everything is assumed to be a business expense. In my opinion, preparing a corporate tax return is easier than filing an individual tax return because it's so much more straightforward, honestly. Capital gains. So if you will remember, with individuals, you could deduct capital gains in excess of capital losses up to $3,000 per year. Okay? Corporations, no such rule. With corporations, you can only deduct capital gains to the extent of losses. Period. No extra $3,000 is allowed for corporations. One thing I will also note about corporations, no preferential rates. Okay? Individuals have preferential rates on dividends and capital gains, right? Not available for corporations. The tax rate that applies is the one that we just looked at in section 11, up to 35%. And if you notice the numbers in section 11, pretty much all corporations are going to be taxable at 34 or 35% just because of the way that it's set up. So, no preferential rates. Okay, so why do we care for corporations if it is capital gain versus ordinary gain? Well, if you will remember, there are something called the netting rules. Okay? Basically, to put it simply, I do not have any desire to revisit the netting rules. With the netting rules, you can only deduct capital losses